Welcome back to The Explainer. I am absolutely thrilled to be guiding you through today's deep dive. Now, if you've been watching the gold markets recently, you know we just witnessed a remarkably aggressive bearish drop. But, what's really going on beneath the surface? Today, we're decoding that massive move and laying out the exact XAUSD forecast for the trading week of June 22nd to the 26th, 2026. We've got a lot of fascinating data to cover, so let's just get right into it.
Okay, let's dive into this. If you've seen that massive red candle that just printed, I have to ask you, are you falling for the trap? It is incredibly easy to emotionally react to a steep price drop, right? People panic, they make rash decisions based entirely on fear. But as we're going to see today, reacting blindly to that kind of drop completely ignores the underlying mechanics of what's actually driving this market right now.
And really, this perfectly captures the divide in the market right now. On one side, we have retail traders. They see a huge drop and they just react, often getting caught on the completely wrong side of the momentum. On the other side, though, we have smart money. Institutional capital isn't panicking. They're already strategically positioning themselves for the next major structural move. In this explainer, we are going to look at the market purely through the lens of smart money.
To do that, we'll be following a highly structured path today. We'll hit the smart money trap, explore the three macro forces driving gold, dig right into the technical analysis of the charts, and finish up with our exact weekly trading plan.
Moving right into our first major section, the three macro forces currently driving gold.
Right now, there is a powerful triad driving gold. First, the undeniable strength and dynamics of the US dollar, the DXY. Second, shifting geopolitical risks across the globe. And third, massive institutional block flows. Let's break these down one by one, starting with the absolute ultimate counterweight to gold, the dollar.
What's truly fascinating about the DXY's projected path is just the sheer persistence of the US dollar. After spending more than a year consolidating between that 96 and 100 range, the DXY finally achieved a successful breakout, securing a decisive close above the critical 100 level. I mean, this is huge. Every single wave of selling pressure on the dollar has been fully absorbed by buyers. Looking ahead, the projected path has the DXY consolidating a bit to test the 101.5 resistance area. From there, it's positioning for an advance toward that 103 to 104 resistance zone. And remember, a strong dollar applies immense, heavy downward pressure on gold.
So let's move to the second macro force to see how this builds the larger picture. Gold is the ultimate safe haven asset, right? It relies on geopolitical instability for its long-term floor, but currently that floor has momentarily softened. We're seeing temporary ceasefire negotiations between the US, Israel, and Iran, though, no official agreement has been signed. Additionally, Russia-Ukraine peace talks have shown some progress, despite no concrete resolution. Because these tensions aren't aggressively escalating at this exact moment, they simply aren't strong enough to offset the heavy short-term pressure coming from the rising US dollar. And that brings us to the third macro force, institutional activity. 7 tons. That is the massive amount of gold purchased last week by the SPDR Gold Trust. After a prolonged period of selling, this is a glaring signal that major institutional investors are anticipating a potential recovery in gold prices in the near term. I mean, that is a staggering volume of capital moving into the market. But there is a massive catch here. The downward pressure from the US dollar is so incredibly fierce right now that even with these massive block buys, any recovery might be strictly limited. Actually, if the bearish pressure continues to dominate, these institutional buyers are going to face intense downside risk. It is entirely possible that some of these massive 7-ton positions may be forced to close at a loss in the coming weeks if market conditions deteriorate further. When capital rotates at this scale, the market is winding up for something huge.
All right, let's shift gears from macroeconomic theory down into the hard, undeniable reality of price action. Section 2, Technical Analysis of the Charts.
And this brilliantly illustrates our widest lens, the weekly time frame. This gives us a really clear picture of the wider reality right now. Gold rallied right up into the 4,400 resistance zone, only to immediately reverse. It reversed exactly where it was expected to, printing a stark bearish pin bar rejection. That weekly close with a strong bearish pin bar is a massive signal for us. It shows that bullish momentum is significantly weakening. Based on this structure, gold is expected to continue its steep decline toward the major support zones at 4,000 and 3,900. But here's the critical risk. If the DXY continues its aggressive bullish phase and gold breaks below 3,900, the floor drops out. A break there opens up a steep decline toward deeper support at 3,700 and potentially all the way down to 3,500. Let's zoom in a bit closer to the daily time frame. This gives us the clearest window into the immediate heavy momentum dominating the market right now. After staging a recovery from 4,000, price hit that 4,400 resistance, and the sellers absolutely took over.
We now have 3 consecutive strong bearish candles. This confirms, without a doubt, that sellers are dominating the market right now. It completely reinforces our weekly view. We are heading toward 4,000 and 3,900 next week. Again, you've got to watch that 3,900 level. A decisive daily close below 3,900 will drastically accelerate the downtrend, essentially opening the trapdoor down at 3,700 before buyers can even hope to regain control.
Now, dropping down to the 4-hour time frame, this is where we shift from trend analysis into locking in our precise timing and execution framework for the upcoming week.
On the H4, the bearish trend remains the absolute dominant force. We're currently seeing a very modest rebound off the 4,100 support zone. But honestly, the buying pressure remains incredibly weak following that sharp sell-off. What this tells us is that we might see a slight temporary recovery pushing up toward the 4,200 to 4,250 area. But don't be fooled. That is likely just a breather before sellers re-engage to push price gradually lower to retest those major supports at 4,100, 4,000, and 3,900.
So, the crucial point is, how do we actually trade this? Let's get into Section 3, the weekly trading plan.
We've mapped out 2 primary sell zones. Sell zone 1 aligns beautifully with our H4 descending trend line up in the 4,240 to 4,300 range, complete with a strict stop loss just above at 4,302. If the market doesn't retrace quite that high, sell zone 2 catches the nearest high probability resistance from 4,155 to 4,200. Both zones are targeting deep downside extensions all the way down to 3,500.
But what if the dollar suddenly loses momentum? Well, here is your backup plan. We have 3 distinct buy zones mapped out at major supports. Notice how buy zone 3 catches immediate support near 4,000. But if we see a much deeper crash, buy zone 1, way down at 3,500, acts as our ultimate institutional discount level. From there, we'd be targeting a massive recovery back toward 4,500.
Before we wrap up, I want to leave you with a real golden nugget of trading wisdom that is absolutely crucial for this week's volatile setup. Beware the false breakout. When we hit these major zones, especially around 3,900 or 4,400, do not get faked out by sudden initial moves. Always practice strict risk management, adjust your stop losses, and wait for the retest before re-entering the market.
So we have our macro drivers, we've decoded the charts, and we have our precise zones totally locked in. But the ultimate question for this week remains, will the DXY hold the line above that crucial 100 level and crush gold further down to 3,500? Or is the dollar about to stall, allowing gold to secretly wind up for a massive, unexpected rally right off that institutional support? The trap is set. Make sure you're the one watching it, not the one caught in it. Keep a close eye on the charts this week, trade safe, and I will see you in our next explainer.